Welcome to our virtual panel today. We are delighted that you have joined us for how to give and get more out of liquidity events. Whether you are a business owner yourself or you work closely with business owners as an attorney, advisor, or consultant, our outstanding group of 5 professionals will give you a great overview of ways to plan more thoughtfully for business transitions and potential liquidity events to help you reach your goals and create the greatest impact for yourself, your family, and your community. Specifically, today we're going to discuss creative ways to incorporate charitable giving into your business planning with some great real-world examples. Because we know that for so many of you, your legacy through your business is about more than just financial success. It also includes the impact you create for your families, communities, and beyond. So I will briefly introduce myself now as your MC for today's session. My name is Elizabeth Burdett, and I'm the Director of Client Engagement for Signature Generosity here at Signature FD. I focus exclusively on partnering with our clients to explore ways to incorporate charitable giving into their overall financial plans. Prior to joining Signature FD in 2019, I worked in fundraising for nearly 6 years, and then before that as an attorney both here in Atlanta and in Texas. So as we move through the event today, just a couple housekeeping items. Please feel free to share your questions as they come up. If you hover your mouse kind of over the lower middle portion of your screen, you'll see a toolbar pop up and there will be a question mark icon, and you can click on that and enter in your questions. And we have set aside time at the end of today's event for questions specifically, so we will be sure to get to those, and we really look forward to the discussion. So a little bit about our panelists and our organizations represented here today. Signature FD is very proud to host this event. Founded 23 years ago, Signature FD is an independent wealth management firm with offices in Atlanta and Charlotte, serving more than 1,300 families with approximately $4 billion under management. By taking the time to understand each client's unique perspective and goals, we create personalized financial plans to help them grow, protect, and give their wealth to live their best lives. Through our unique Signature Generosity initiative, we provide the resources, guidance, and expertise to support our clients' journeys of generosity. Our generosity team helps clients create their own plans for giving to reach their goals and create change in their communities and beyond. So I'm delighted to have my colleague Russ Carley with me today. He is a partner with Signature FD and a member of the firm's investment committee and the director of our Charlotte office. With the passion to help people do more with their wealth, he provides strategic investment consulting and comprehensive wealth management services to high net worth clients. He specializes in working with successful executives, business owners, and other corporate professionals to help them make informed and effective financial decisions. Prior to joining Signature FD, Russ worked at SunTrust Investment Services and TIAA Craft. He holds a Bachelor of Arts in Economics and Political Science from the University of North Carolina at Chapel Hill. We also have today with us Clay Grubb from Grubb Properties in Charlotte. Founded in 1963, Grubb Properties, Inc. is a private equity real estate fund manager with a fully integrated subsidiary specializing in multifamily residential housing and commercial office properties. The company has received numerous sustainability designations and recognitions. It maintains corporate offices in Atlanta, Charlotte, Cary, and Winston-Salem, North Carolina. Clay began working for Grubb Properties at the age of 12, specializing in residential mortgage collection. Since becoming CEO in 2002, the company has grown significantly and been a top quartile producer of returns for its real estate investment funds. Under his leadership, the company has successfully transitioned from a family-owned business to an employee and board-owned company. Clay received his law degree from the University of North Carolina School of Law and his Bachelor of Science in Management from the A.B. Freeman School of Business at Tulane University. He is involved in a number of civic and community organizations, including as a finance leadership fellow with the Aspen Institute. Clay is also the author of Creating the Urban Dream, published in 2020 by Forbes Books. We also have Holly Norvell with us today from Johnson, Allison, and Hord. Over the last 100 years, the Charlotte law firm of Johnson, Allison, and Hord has grown to approximately 50 attorneys and serves clients that have been with them for decades. The firm and its lawyers have consistently been recognized by peers and respected legal and local publications, including Chambers USA, Super Lawyers, and the Best Lawyers in America. Its attorneys specialize in a wide array of practices, including business succession planning, tax and mergers and acquisitions, to name a few. It is a member of Meritas, a global alliance of over 7,000 lawyers serving in 184 full-service law firms across more than 93 countries. A partner with the firm, Holly Norvell is an experienced estate planning lawyer. She has 5 areas of focus: business succession planning, complicated estate administration, charitable and philanthropic guidance, fiduciary litigation, and federal, state, and income and generation skipping transfer tax planning. She is also a licensed CPA. Holly received her BBA, MPA, and JD from the University of Texas at Austin, hook 'em horns, and was recently recognized as one of the top 100 attorneys in North Carolina. Holly serves in a leadership role for a variety of civic and community organizations, including on the board of the Dowd YMCA and Atrium Health Foundation Professional Advisory Council. We also have Catherine Warfield with us today from the Foundation for the Carolinas. Established in 1958, Foundation for the Carolinas is the leading community foundation for a 13-county region in North and South Carolina. With more than $2.5 billion in charitable assets across nearly 3,000 charitable funds established by families, nonprofits, and businesses, it is one of the largest community foundations in the U.S. The foundation works with business owners and philanthropists to leverage privately held assets for charitable impact, with expertise and products to maximize tax benefits for gifts of closely held business interest. We are joined today by Catherine Warfield, Senior Vice President of Philanthropic Advancement at the Foundation. She leads a team dedicated to business development and relationship management for the Foundation's major client segments, including family offices and family-owned businesses. Catherine is also a certified financial planner. And now I would like to introduce today's moderator, my other colleague from Signature FD, Leah Mabry. Leah is an advisor in Signature FD's Charlotte office, where she provides comprehensive financial planning, tax, and consulting services to her clients. She works with a wide array of clients, including professional athletes, corporate executives, entrepreneurs, and wealthy families, serving their financial and tax planning needs. Prior to joining Signature FD, she worked for 18 years at several large accounting firms. She holds a Bachelor of Arts in Accounting from Wofford College and is a certified public accountant. So I'm going to turn it over to Leah now to kick off our panel discussion.
Thank you so much, Elizabeth. As everyone can see, we have quite the distinguished panel here today. They have great insights, experience, and perspectives working with business owners to navigate complicated transactions and incorporate charitable giving into strategic planning decisions. So now let's get right into our questions. Holly, in your career as an attorney representing business owners, what have you seen as the most common mistakes or misunderstandings in approaching a liquidity event for their businesses?
Thank you, Leah, and thank you for inviting me to speak on this panel. One of the things that I love about what I do is I work with families and business owners across a variety of different industries. And I see and counsel families and business owners as they approach a liquidity event. And as I work with these families, I notice certain trends and certain mistakes, things that I wish we could have done earlier, things I wish we could have done more efficiently, things that I wish we could have addressed for a client if we had had sufficient time to do so. So the number one mistake that I see most missed opportunities with, Leah, is a missed window of opportunity to engage in pre-transaction planning. Oftentimes that business owner who is so successful and has so successfully grown a business has that growth mindset and is looking now at the finish line of liquidity, trying to carry that business through to the liquidity event, and instead, in that focus on that, neglects things like making sure the personal house is in order, and neglects the window of opportunity to engage in thoughtful, tax-efficient pre-transaction planning. And that could be planning for the business owner's family members by engaging in transactions that would allow the family to significantly reduce not just income taxes, but also estate and gift transfer taxes, as well as missed opportunity to take advantage of philanthropic planning, charitable planning, which would allow the family to leverage the impact of their gift by reducing taxes. So the number one mistake that I see is really it's a mistake of missed opportunity, a window of opportunity that closes before the business owner really has a chance to and really thought about switching gears and thinking about what is life going to look like after the liquidity event. Leah.
Great. Thank you, Holly. So Clay, I'm going to go to you next. As a leader in Charlotte's business community and CEO, chairman of your own company, what are some things that you have learned growing your business that maybe you didn't anticipate? And is there anything you wish you had known in creating a growth strategy?
Leah, thank you, and thanks for having me as well today. And hello to everybody out there. I hope everybody is doing well and staying safe. And thanks for the question. I think it's interesting. I think back on Marian Wright Edelman. I think is a big inspiration for me. Who in my time involved with her on the Children's Defense Fund, she used to always say, if you go to where there's need, you'll always have a job. And I would say, from mistakes early on in my career, has probably been focusing on trying to chase that profitable opportunity today versus focusing on where the need is. And so today, Grubb Properties is laser focused on value-based urban housing for millennials and working families where there's the greatest need. My father actually started this company back in '63, providing housing for Black families in a time when there was redlining by all the banks, and so they were cut out of the lending world. And in fact, I think I've heard quotes as much as 98% of all mortgages between 34 and 68 went to white families, and so he saw this as a great opportunity, and it became a very sustainable and profitable business that actually provided homes for hundreds of families up in Lexington, where I'm from. And when I took over running the company at the time, we were actually building the first $1 million condos in downtown Charlotte and the first $1 million condos inside the Beltline in Raleigh, and that proved not to be a sustainable business in 08, 09. That was a very uncomfortable spot to be. So I think today we're very focused on how do we impact people's lives. In fact, through our opportunity funds and our new funds, we're providing 10% of those dollars purely for, in one instance, to help fight gentrification on the west side in Charlotte. And we've closed 4 investments with Black developers on the west side. And I would argue that in this time of pandemic, they're 4 of our most sustainable and profitable investments we have on a risk-adjusted basis.
Hey, thank you so much for sharing that. That's good information, and I appreciate all the good work you're doing in our community. So now I'm going to jump to my colleague, Russ. So Russ, in your experience working with high net worth individuals as a financial advisor, what are some planning opportunities around business transactions that people should consider?
Yeah, thanks so much, Leah. I'm happy to participate. I think this panel is going to be focused a lot on the charitable component of integrating in and around business transactions. And so Holly made a great point earlier about getting started earlier, not only with collecting thoughts, but engaging the appropriate professionals. And I know that Catherine is going to talk here a bit more about the work that the Foundation for the Carolinas is doing. I do think that the charitable component being integrated into a transaction is extremely important. There's also a couple of other really unique challenges when dealing with business owners, both pre and post transaction. One of those is dealing with the tax efficiency of any transaction and how do you optimize the tax efficiency of a transaction. There's a couple of things that we're doing that's unique with business owners. One is a relatively new program that was part of the 2017 Tax Cuts and Jobs Act around opportunity zone investing. In 2008, when the guidelines around this piece of legislation were clarified, 25% of U.S. states and territories are designated as opportunity zone areas. These are typically lower middle income areas that they're trying to generate capital investment, reinvestment, spur economic activity. As an incentive to make new investments in these areas, taxpayers that have a realized capital gain from any source, it could be from a business sale, it could be from selling another piece of real estate, it could be from a common stock sale, have the opportunity. There's a 180-day window post-transaction where that taxpayer can reinvest all or a portion of that realized capital gain into a real estate related project or a fund that focuses on real estate related projects in and around opportunity zone areas. So one of the ways that we've been trying to help business owners post transaction is identifying viable qualified opportunity zone investments to build out a portion of their post transaction portfolio into these areas. It's an opportunity to get access to private real estate investments in a tax efficient way. There's three primary benefits to the taxpayer in making this reinvestment inside the window. The first benefit is the capital gains that are realized and reinvested into a QOZ are deferred until calendar year 2026. So there's essentially, if the event happens this year, there's a 6-year deferral on the capital gains taxes that would be owed. The second benefit is there is a 10% step up in the cost basis, and so effectively, if you hold tax code the same now versus 2026, there would effectively be a 10% reduction in capital gains taxes owed. And the third and final benefit to the taxpayer is that any subsequent investment in the QOZ projects, if held for a full 10-year period, receives a full step up in basis on the appreciation of that investment itself. So if the underlying real estate investments that they make inside the QOZ are profitable and see good attractive growth, that can essentially be stepped up capital gains tax free. So that's a really interesting planning opportunity that's really come about in the last couple of years. Clay and his firm at Grubb Properties have been very active in this, and we're happy to have partnered with them on a number of their qualified opportunity zone deals. Secondly, just one other kind of thought on this is one of the issues that we've seen with entrepreneurs that have gone through a liquidity event is the bulk of the capital post-transaction is in taxable, non-qualified types of investments, which means that any dividends, interest, realized capital gains are going to flow through annually on their tax return. So how do you build a portfolio that's tax efficient post-transition? It's a little bit different than working with corporate executives, which traditionally have larger qualified types of accounts, 401ks, deferred comp plans that they've been deferring capital into over time, which has tax qualified treatment. So two things that we're specifically doing with clients, entrepreneurs post-transaction. One, we are looking for opportunities to build tax efficient structures, and we've done that through offering private placement life insurance and private placement annuities. The long and the short of that is that it's a way to invest capital inside of a structure that can then grow and compound tax-free and tax-deferred over time. Concept behind that is that there are going to be certain types of investments that we're doing in a portfolio that are less tax efficient than others. Hedge funds, credit-oriented investments where the bulk of the return is going to be income as opposed to long-term capital gains, which have preferred tax treatment. So building a structure there where we can make those types of investments in the most tax efficient way. And then secondarily, how do we build tax efficiency into the more traditional types of investments in the portfolio, common stocks, growth-oriented investments. We do that by building a portfolio of individual stocks and actively tax loss harvesting that to offset gains in the other sides of the portfolio. So those are just a couple of, I'd call them unique opportunities post-transaction to tax optimize the portfolio after the liquidity event. Leah?
Very good, Russ. Thank you so much for that. Now we're going to shift over into the charitable giving aspect of our discussion. And I'm going to go back to Holly, and then I'm going to jump over to Catherine. So Holly, what are your top recommendations for how to incorporate charitable giving into a long-term business strategy?
Yeah, that's a great question, Leah, because there are several ways that it can be done. But I'll tell you, my personal bias and preference is for to see a client implement a strategy that is flexible. I like flexible and tax-efficient charitable planning strategies. So, for example, oftentimes a business owner will know kind of what after-tax value he or she wants to give to charity. So we have an idea of what the value will be that's given. And there's a couple ways that the business owner could structure that. The worst possible way to do it is to sell the business and then donate those after-tax dollars to charity. That's one of the least efficient ways that a client can do it, but oftentimes folks who don't get their kind of personal house in order sufficiently in front of the liquidity event end up taking that tact. But there's a better way, and there's a more tax-efficient strategy. And that is that a client could gift away a portion of the business interest prior to the liquidity event to a tax-efficient vehicle that would not recognize income tax on the gain on the sale. And what that does is actually leverages and maximizes the impact of the client's charitable gift. And so I think that sometimes folks are a little wary about going down that path because they think, well, I don't know exactly where I want to benefit. I'm not sure exactly which charity I want to give this significant sum to. And the good news is there are ways to build in flexibility so that a client doesn't have to know exactly which charity is going to receive. The client can implement a gift to a donor-advised fund at a community foundation or other sponsoring organization, which will allow the client to take advantage of the income tax deduction on the gift to charity, defer and not recognize gain on the sale of the business, and defer the time at which the client decides to make gifts to receiving organizations. So the client still has plenty of time, flexibility to decide exactly what that philanthropic impact will look like in the community and when it will occur. So I love strategies that are tax efficient, that are flexible, and so I particularly like structured gifts to a donor advised fund, or sometimes a structured gift to a charitable remainder trust, which can do a similar thing if implemented properly. Leah?
Excellent. Thank you, Holly. So Catherine, I'm going to finally get to you. You have a really unique perspective working with advisors, community organizations, and business owners at the Foundation for the Carolinas. What is the Foundation's typical role in these types of transactions, and how do you partner with business owners, attorneys, advisors, and other parties?
Great. Thank you. Thanks so much to Signature FD for putting on this event on and for asking us to be a part of it. I think before Leah answer your question, I kind of just wanted to share that this discussion to me is exactly why these conversations and the momentum for community impact, like Clay was talking about, are happening. And I think it's wonderful to see. And for me, I've been at the foundation for over 10 years now, and so especially in light of the current pandemic and what's going on in our world and the increased community needs and the pressures our nonprofit communities and sort of most vulnerable are feeling, the fact that we are being more strategic, and the we being the collective we, about how to leverage the full range of assets for people who are charitably inclined, I think is really exciting. And certainly I think this idea of the for-profit and nonprofit and business and philanthropy blurring, those lines certainly are blurring and continue to do so. And I'll look no further than the corporate support for the COVID-19 response fund in our community as indicative of, again, just sort of the private sector really stepping up. And I think about Clay and how you have incorporated community work as part of your business strategy as just the perfect example. So, thank y'all for that. Here's what we know. We know that the majority of assets in this country are held privately, private businesses, private stock, real estate, and the like. And yet we know that the majority of charitable gifts in this country are made using cash and publicly traded securities. And what that means is there is an enormous amount of potential for additional philanthropic capital to be funneled into our communities and communities around this country using private assets. And so, this is good news for sure, especially for people who want to do more and to do good, like Clay. And so one of the roles that the Foundation for the Carolinas plays, we are the community foundation. So for anybody listening that doesn't have familiarity with the community foundation, we're a geographic foundation, typically place-based. We are a bona fide nonprofit, but we serve individuals, families, companies, and nonprofits through a range of solutions. And one of those is helping individuals and private asset owners take an illiquid asset and make a charitable gift that ultimately can be used to fund a variety of charitable goals. Just like Holly said, very flexible, typically going to a donor advised fund at the end of the day to engage family, to engage friends, to leave a legacy. And so I think one of the ways that the foundation works in that space is to first and foremost educate people and make people aware that this is even possible. Because a lot of times, with the demands, especially in private business and in corporate America, frankly, the demands might not lend itself to think, gosh, I could actually use this asset for charitable giving. And so first and foremost, I think is making donors and prospective donors and their professional advisors aware that this is a possibility. And that to the extent that these asset owners have interest in philanthropy, that the Foundation for the Carolinas and other organizations may have the experience and expertise to actually make these gifts possible. And as Holly said, make them possible in a tax efficient and tax advantaged way. Usually we're approached by the professional advisor. Sometimes it's the donor, but I think a lot of times our work is in partnership with everyone on this call today to serve philanthropists in our community. So typically the call might come from the professional advisor in advance of a liquidity event. And they say, this is coming up, the owner has charitable intent. We're trying to see if there's a possible way to incorporate gifting as part of this overall liquidity event. And it's really a conversation with our team. We have significant depth of legal expertise on our team to talk through all of this with donors prospectively and their advisors. So can we accept the asset? Can it be gifted? Can it be transferred? Can it be valued? Can it be liquidated? Is it liquidated in the short term or the long term? So there's the complex conversations around the asset acceptance and holding and liquidation. And then the other fun part, I think that part is actually really fun and interesting, but the other fun part is, okay, then how do we support this owner, this philanthropist, in ultimately accomplishing their charitable goals on the back end after the liquidity event has happened? And so I think we are able to leverage our collective experience to help guide donors through that conversation in a way that can be really fruitful. In 2012, the Foundation for the Carolinas created a tax advantage structure to basically facilitate these gifts in the best way we felt was possible from both IRS, donor considerations as well as charitable considerations. And since then, we've received facilitated over $225 million in gifts of this kind, everything from commercial real estate, and Clay is going to talk about that a little bit and our experience working with him, as well as private stock in companies like Avid Exchange, and then operating businesses and family real estate. And so I think one of the benefits, and Holly touched on this, as far as working with a community foundation or ultimately a donor advised fund to make this kind of gift, is you can take one substantial asset, and we understand these assets are typically very important to donors, right? They might be the culmination of their life's work if it's a family-owned business or an entrepreneur. You can take a single asset and find a way to leverage that tax efficiently to accomplish a wide range of charitable goals and intent. And so the idea of alleviating the pressure and creating flexibility, as Holly has said multiple times, to decide later how that gift is used, I think is also quite appealing to donors in terms of evolving into what their impact is that they want to have. So back to you, Leah.
Thank you. So I want to follow up on that, and I want Clay to chime in as well. But Catherine, can you and Clay talk about the way that you worked together back in, was it 2016, and how you kind of structured that deal, and just kind of explain to the audience how that worked?
Clay, you want to start, since they just had to listen to me for a while?
Sure. I think that and it's interesting because we're very focused on working with the best-in-class service providers, and I don't think it dawned on me, but Johnson Allison Horde is actively involved in all of our giving and estate planning, and and Signature FD's been a great partner for a long time as well. But the Foundation from the Carolinas, Catherine and her team really stand out as a group that will bend over backwards to make it very easy for donors to manage what they're doing and how they're doing it. And so it was really interesting. We in this particular instance in 2016, we have a project called Glen Lennox in Chapel Hill. It's probably the best known brand for living in certainly in the Carolinas. The who's who of my father's generation was all raised there and went to school there. And as I said, the who's who of my generation was born there. And so the university had spent umpteen amount of times with classes trying to figure out what to do with this 70-acre tract that's a quarter mile from the campus. And so when we were in a position to actually buy our partner out of it, at that point in time, we thought it was a great opportunity for us to actually donate some of the ownership. And so we wanted to donate some ownership to University of North Carolina at Chapel Hill, as well as some to the University of North Carolina at Charlotte, and specifically their real estate programs, because they had done so much, and they have these student-led funds that invest in real estate. And in fact, UNC Chapel Hill in 2008 had Glen Lennox as their national case competition case, and so it was a wonderful opportunity. And trying to work through that with the universities was not did not lack for complexity. And so our simple answer was to call up Catherine. And so I remember Johnson Allison Ward's David Lewis and I got on the phone and called up Catherine. And Catherine, I can tell you, I'll let you tell a little bit about the solution if you want.
Thank you. That's perfect. Thanks. And I think it's, I think Clay, in some ways, look, the gifts are as diverse from one another as the number that we've accepted, right? There's no one fact pattern. And I think that's one of the reasons that these conversations typically evolve and happen over a couple of meetings, and again, require a decent amount of trust. But I think we've also been able to leverage our collective experience to get better. Clay is a little bit of a rare example in that he knew the ultimate charitable impact he wanted to have with this particular asset. And that happens every once in a while, and they're probably less frequent than the person that just says, I know I can save some taxes, and I know I want to incorporate charity, but I don't know what I want to do yet, right? And so the good news is, as Holly said, flexible and can do both of those things. I think in a lot of ways the contribution is not too just like, making a gift of publicly traded securities to a donor advised fund. It's just that we have to do some work on our end to ensure that we can accept, hold, and liquidate that asset, right? But similarly, there is the transfer of the asset. The donor gets an income tax deduction, a favorable income tax deduction, because we as a sponsoring organization are a public charity. It is a lot more difficult to give away private assets to private foundations for a number of reasons that we won't necessarily go into today, but it is important to note that. And so this idea of can we accept it, and we get to asset acceptance, the donor gets an appraisal, claims that charitable gift, and then we work in partnership with the donor, the asset owner, and possibly the company to maximize the liquidity event to create, ultimate charitable impact, whatever form that takes. I think one of the things that's been surprising that I would mention is that we knew when we started this work that we would appeal to donors for lifetime giving. One thing that's been surprising there is this idea of repeat gifts. A lot of people in our community own a variety of assets. They may have invested in a company. They may have family-owned land. They may have their own operating business. And so different real estate ventures. And so this idea of repeat donations has been something that's been surprising to us. I think the other one has been the facilitation of illiquid gifts in an estate planning or testamentary context. And so that was one that I think we had not anticipated to the extent it has been taken advantage of by our donors who were saying, I have a business, an operating business, and I want to find a way to either have it continue at my death or to be transferred tax efficiently at my death. And so, I think those are even more significant because, again, you're planning hopefully far into the future, in a very complex way. But just like conversations with Clay, you get to dream with them in terms of what they want to accomplish. And that's, that's really meaningful and special as well.
But, and I think that's a great comment. I mean, actually, I think when Catherine was an intern in high school at the foundation, we set up our first donor advised fund, and it was a very modest fund. It was a gift to my wife for her birthday. So basically, she would have the equivalent of a checking account to make donations. We had some stock that had done very well. I think it was a sub $25,000 or $30,000 type of gift. But that was what we initially set it up with, and that worked very well. We continue to occasionally get lucky in the stock market, and then it becomes more tax efficient for us to donate to that donor advised fund. We've now evolved it into the Grubb Family Fund. It used to be just the Deidre G. Grubb, and then she changed it to the Deidre and Clay Grubb, and now it's the Grubb family because both my kids have actually contributed stock now to that fund as well, and so they participate through that, and that's been fun. And then when we had Glenn Lennox, it was okay, let's call up Catherine and see if they have a creative option. So we donated that contribution to them. They are the owner voter of that, and all the cash flow and all the net proceeds eventually flowed to those two schools, UNC Charlotte and Chapel Hill. And we're currently working on another one with a private investment that we made 20 years ago, and it was a need-based investment that has done very well. And so we're currently realizing that the tax hit will be tremendous, and so Catherine and the folks at Johnson Allison have stepped forward with basically the same solution where it will go into the Grubb Family Foundation. And then we've talked about doing something in Lexington with my parents, and they said, well, eventually, whenever you're ready to set that up, we'll split that out and move it to the Lexington Foundation and do something in honor of my parents, Bob and Rochelle Grubb, and all that they did in that community. So I'm very appreciative of that. And Leah, I've probably taken more time than you counted on, but thanks for letting me chat in.
Hey, Leah,
go ahead.
I was just going to jump in and make one additional point. So we're talking a lot about how to tax optimize in and around business transactions. But one of the things that we noticed in working with a number of different types of clients in the most recent set of tax changes is one, I think it gained quite a bit of notoriety, but the standard tax deduction for individual and married joint filing taxpayers essentially doubled. And the three primary itemized deductions that most taxpayers claim are state and local taxes, mortgage interest, and large charitable gifts. And so what we noticed with a number of our clients that don't have mortgages and don't have mortgage interest to deduct, and their state and local taxes are capped at $10,000, which was part of the new tax law, is unless you were making if you were married, unless you were making $15,000 per year in charitable gifts, then you were losing the opportunity to itemize those. So it goes back to the discussion that Catherine was making around the benefits of a donor advised fund. It's certainly a great vehicle for pre-sale, pre-transaction planning, but even if you're not a business owner or a landowner and you're making charitable gifts each year, you may not be getting the tax benefit for that due to the new tax law. So a donor advised fund can be a very effective tool to lump multiple years worth of charitable giving. If you're giving, let's say, excuse me, $10,000 a year to charity and you're not qualifying for an itemized deduction, maybe you make a one-time $50,000 donation into your donor advised fund, you itemize and get the benefits of the tax savings in that 1 year, and then you can claim the standard deduction in future years. So just wanted to interject that. I know we're talking about kind of large transactions, but the donor advised fund, excuse me, concept can make sense even without that.
But Russ, I think it's a great point, because what you have is with investments, it's lumpy. You know, if I were to, you know, the charities we like to support, we like to give to every year because they count on that consistency. Well, the reality is to provide consistency, typically you're using your after-tax cash. But the fact that, hey, you know, we like to give a certain amount of X every year. Well, if I suddenly have an event that's at Y 1 year, well, we get a nice charitable deduction that year, and then it sits there, and then we can write those checks. We don't have to give it all away that year or the next year, or even can let it build over years. And the beauty also is I don't have, you know, 70 typed items I got to list out on my tax return. It's one donation, and they then list all the 70 different things. Or
your accountant thanks you for that, I'm sure.
Sometimes we don't need to say anything more than that.
Right. And the other thing about a donor advised fund that I love, and a lot of people don't think about, they're more focused on the tax benefits, but the funds are invested within the donor advised fund. So I was looking at one the other day where somebody had contributed $100,000 worth of appreciated stock a couple years ago, and has given away about $16,000 since, but the balance of the donor advised fund is $92,000 because it's been invested. So it's beautiful. Right? Yeah, right. I mean, it's the best. It's one of my favorite planning tools.
Well, and I think kudos to, you know, I think that, I know we're kicking back to you, Leah, to keep going. I think the only thing I would say is I think Signature FD, I think what y'all have done to incorporate generosity and philanthropic giving as part of your practice and advice to clients. And you hear these people from Signature FD talking about their expertise and their advocacy for these types of tools. You know, I think that is such a wonderful thing. Because I think there are some that again separate the two, right? Business over here and the charitable planning over here, for-profit, nonprofit. When the reality is, I think when they all come together like this, it really can yield benefits for everyone involved. And so thank y'all for advocating for that, because frankly, if we do our job right, you know, more dollars will be unlocked for charity in whatever form that takes. You know, that's what we're after. So.
That's right. And charitable planning is so much fun. My favorite clients are the clients who are charitably inclined. So let's see. So it is 11:44. Elizabeth, have we had any questions come in?
We do have a couple of questions. So I think this is a good time to kind of pivot to some questions if everybody's ready for that. And please feel free, everybody, if you still have a question and have not had a chance to submit it, or it comes to you now, remember you can submit it by kind of hovering your mouse over the lower center portion of your screen and clicking that question mark. I'm going to give this first question. I'm going to start it with Holly, but obviously anybody can join in at any point. Holly, what are the best questions, in your opinion, that a business owner should ask their attorney or their accountant or financial advisor in their business planning process? Like, kind of what are they? We know you've said that you should start early and be flexible and thoughtful, but what are the questions they should be thinking about?
Well, that's a great question, Elizabeth. And I'll piggyback on a couple of comments that have already been made. One of the comments that was made was that Clay spoke about was about involving the next generation in his charitable giving, and how his parents had a legacy. He's involved his children and his wife in giving. And I'll say that's one of the questions that a client should ask himself or herself of their advisors is, how can I get my family involved? The truth of the matter is we're talking about business owners on this panel presentation, but we don't counsel business owners. We counsel families who have an interest in a business. We're counseling families, and families, you know, may grow in business. That's one of their objectives, but their objectives also are raising generous children, raising children who are givers and not takers in the world. And philanthropy is really a way to leverage that conversation and involve children. So I would encourage our clients and participants on this call to ask their advisors, not just, what's the most tax efficient way to dispose of my business, which is a valid question, but also a broader question on how can I use this event to encourage my children in becoming the kinds of people in my community that I want to see leading the community when I'm no longer here. So that's one of the comments I would encourage. The other is I would encourage clients to think about what is their philanthropic impact going to look like. So for example, we've talked a lot about the flexibility that a donor advised fund can provide and how it is a conduit for achieving a client's ultimate charitable objectives. But I would encourage a client to consider and talk with their advisors about, well, what can my impact look like? A lot of times, families who are new to philanthropy have really no idea what giving vehicles are available to them. So for example, I have X dollars to give away. Is this enough for a scholarship, an endowed professorship? Is this enough to put my name on a building? Is this enough for me to have my name on the entire business school? Those are all questions that a client can ask of their advisors and help gauge kind of what is it the impact that they're passionate about, and also what's the impact that they want to see in the community.
That's great. I've got another question that's come in here. I think this is, I'm not surprised by this question at all. So I'm gonna pitch it to Russ and Leah, but really even can join in. What impact, if any, does our current financial climate have on this entire conversation for business owners? I mean, we've got, I'm now riffing on this question, but we've got COVID, we've got changing tax policies, we have an election coming up. So, if there's anything in this particular atmosphere that might change things, what might that be?
Yeah, I'm happy.
Go ahead, and I'll chime in.
Okay, yeah, happy. I've got a few thoughts. So a lot of what we talked about is leveraging gifting appreciated assets, business units, land. And so obviously, anytime there's periods of volatility, it can make it more challenging to identify those opportunities. I'll reinforce a point that Clay made earlier, which is kind of the smoothing effect that a donor advised fund or a private foundation can have, where you can be opportunistic in the timing of granting to the donor advised fund, and then be more systematic in how you grant it out to charities on the back end. So one of the things that we're doing, obviously with the market, and the market volatility that we've seen this year in March and April, we weren't making a lot of new charitable donations into a client's donor advised fund with commonly held stock, because of the fact that the values were temporarily depressed. And so I think you want to opportunistically use any period of really strong performance, whether it's on a project, like Clay was talking about, the real estate project, whether it's you selling your business, but you certainly want to gift while asset values are high. So that's the first thing that I would say. There are strategies kind of on the opposite end of the spectrum on considerations when asset values are potentially temporarily depressed. And so things like one of the things that we were doing in March, April for clients was converting some of their pre-tax IRAs into post-tax IRAs through a process known as a Roth conversion. You do that. The strategy there is if you can do that when asset values are temporarily depressed, you pay taxes at a lower base, and then any growth subsequent to the conversion is all tax-free. Same thing with, depending upon, goals of the family, funding accounts for their children, whether it be outright in a custodial account or in a 529 account, bringing forward those gifts while asset values are depressed to try to take advantage of the recovery. So I think there's actually strategies on both sides when things are going particularly well from a market perspective, and then things when kind of the silver lining when things aren't going well, what's some proactive planning and strategic opportunities there. A couple other really quick thoughts. So, and Holly may have some thoughts on this too. So the interest rate environment that we're in right now is very low, and it's very favorable for borrowers. And so there are strategies around lending to family members, intra-family loans based off of rates that that are set by the IRS that can be a very appealing way from an estate planning perspective. So, kind of both ends of the spectrum there. I think there's ways that you can try to take advantage of this current environment. Elizabeth.
Well,
Great.
yeah, and I was just going to add, I mean, it is a really interesting time as the the markets are so bifurcated. I use an example of Square stock. It was $8 a share, 4 or 5 years ago, and today it's $155 a share. Well, there's only so much you want of that in any account. If you're using Signature FD, will certainly make sure that diversification and that type of thing are important. And so instead of selling that and paying all that taxes, it's a great thing to give. And so that's what you're seeing right now. The whole tech explosion, I think, is going to result in, and then I think there's a question just about real estate gifts. We've done a number through the years. One, back in 2008, when it was pretty clear that the real estate values were going away for a really long time. I remember I had a 70-acre tract that an African-American church wanted to buy 5 acres, and we ended up getting such a great appraisal for all 70 acres. It was cheaper for us to just give them all 70 acres than to carve off 5. And we did a similar thing in South Park in Charlotte. There's a historical black cemetery there at Morrison that is from the 1860s, Lloyd Presbyterian Church. It's now today the Greer Heights Presbyterian Church, but there are old cemeteries there. And we were able to actually take just the cemetery parcel and a little bit of additional developable land and get a nice appraisal. And at the time, North Carolina also gave tax credits as long as you preserved it for conservation. And we've actually done a couple of those where we've preserved for conservation at the same time.
Great. We really only have a couple minutes left for questions, so I'm actually just going to open it up to the panel. If there's anybody has any closing thoughts or something they wanted to share that maybe occurred that didn't apply to a specific question, but let's take about 2 or 3 more minutes, and if anybody's got any other thoughts or things they want to share, go right ahead.
I've got something that I'll add, Elizabeth.
Great.
One thing that Clay mentioned was, and Catherine, I think you mentioned this also, was about how a client's giving changes over time. I want to just touch on that for a brief moment because I see in my practice a cycle of how clients become involved in philanthropy and how they get interested in charitable giving. A lot of times I will see a client who makes certain gifts out of cash resources annually, and so they're annual gifts, and that can last for a number of years. That's usually the way a client first gets interested in charitable planning and charitable giving. And then the client will expand that to kind of phase 2, which is what am I going to do with all my resources when I pass away? Well, let me carve off some portion for charity at death also. So then we're talking about testamentary planning to give away a larger sum at death. And then my favorite phase is this, what I call phase 3, which is the client who thinks, okay, I've set aside this much for my family and I've set aside this much for charity at my death. Why am I waiting to die to give it away? Let me start making large transformative gifts now, and let me start seeing the impact of my gift in the community. And I just throw that out there because each person is on a different place on their journey with charitable giving. But as I see and map out journeys, for families, that's kind of the journey that I see among my clients. And it's fun to work with families and clients and business owners who have, are at different points on that progression. But between you and me, the most fun are those ones at the very end, that phase 3, who decide, why wait till I pass to give it away? Let me start making large transformative gifts now.
And I would say, we've probably pushed Holly and her team to phase 4 or 5, probably, where I feel like, we used to go in and our will would specifically say, well, we're going to give 5,000 here and 10,000 here. And then you're having to update your will because your view on that charity's changed. And so I remember the last iteration was we went in and said, okay, what's the most tax efficient way to work through what our will look like? And then let's, whatever goes to charity, let's just give it to the Foundation of the Carolinas, and let's set it up so that there's a program where they have a voter and each kid has our vote. So if our kids can't agree, they can do the tie on how that's handled. And if there's not there, the Foundation of the Carolinas needs to rely on the history of what we've done the last 4 or 5 years, as opposed to, because they built all this wonderful history that otherwise we wouldn't have. And so that's been fun as we've worked through that, trying to think through how that goes, and it allows us to evolve, because we certainly don't donate to the same charities we did 10 years ago. We donate to plenty of the same ones, but there's some that we don't anymore, and certainly some that we've added.
And
yeah, I would just, I'm sorry, Holly.
I would say, and Clay, I would take that a step further and say that, charitable giving evolves over a lifetime. It also evolves in response to community needs. And I think that's one of the areas where Foundation for the Carolinas really shines in our community and is a thought leader in our community at looking at what are the current needs today, not just the obvious ones like COVID-19 the past few months, but what about leading on opportunity? What about economic mobility? What are the current needs in our community? And so just to echo your point on that, Clay, as giving interests change, also community needs change, and having a local community foundation that's in tune and is a leader and what the local needs are is really an important component in a client's charitable giving plan.
And I thank you, Holly. I totally agree. And I think maybe this is a good segue back to the Signature team, because I was in a meeting with Elizabeth and Russ and Leah in the first week of March, I think, right? So a very different time in our world and in our community when we were talking about doing something like this. And I think kudos to them for forging ahead. And for me, I think because, to your point, Holly, community needs do change, and we're smack in the middle of them changing before our eyes. And so to sit back on the conversation about how philanthropy can make a difference in this time, I think is a missed opportunity for the community, right? I mean, as well as the tax benefits that Russ and Leah and everybody are so well aware of, because we're in the middle of a time when the needs are changing, evolving daily. And so we've gotten a lot more calls in the last 6 months, especially around testamentary planning, I think, in light of what's happening. And so I think, again, it's I'm really appreciative that this event took place, not in person as maybe planned initially, but took place nonetheless. And thanks to the Signature team, because I think it's still so important to have the conversation. So,
well, Catherine, I think that's an excellent note to leave on. Thank you so much. And I want to just say a huge thank you to Clay and Catherine and Holly and Russ and Leah for joining us today, for having this incredibly dynamic discussion. And thank you all to each and every one of you who joined us today for being here. Again, we would have loved to have done this in person, but I think this worked well. You can see on the screen contact information for our panelists, so please feel free to reach out to them with your own questions or any follow-up, things you want to follow up with them on. If you want more information about Signature Generosity specifically for our firm, you're welcome to reach out to me. My email is elizabeth.burdette@signaturefd.com, and Burdette is Burdette. You will receive a follow-up email after this event with a survey. It's very quick, and we would love to get your feedback on how we did today, and so we can continually improve. And we will also be later sharing a recording of this event as well. So to everybody, on behalf of our entire group, Signature FD, Foundation for the Carolinas, Grubb Properties, Johnson, Allison, and Horde, thank you for being here. Please stay safe, stay healthy, take care of each other, and have a great rest of your day. Thanks so much.
Thank you.
Thanks.
Thanks, everybody.
Thanks,
Bye-bye.
all.